Good afternoon, everyone. Thanks for joining us for Washington Post Practical and Tactical Actions for Plan Sponsors. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program, and you must answer at least 3 of the polling questions that we will be launching. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. So let's get started. We are joined today by Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoints on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Rich, let's start talking practical and tactical actions for plan sponsors.
Lizzie, thanks for the introduction today, and everybody who's attending, I appreciate you being here. We do have a lot of material to cover, and we do expect to go the full hour. So again, as Lizzie mentioned, if you have questions, put them in the question box, and we'll get to as many of those as we possibly can today. So a couple of things we're going to talk about today is, number one, Department of Labor and IRS enforcement update. We're going to go through some of the a lot of the implications there. We're going to go through the current administration's retirement-related initiatives. We're going to also go through a lot of the legislation that is out there, that is pending. Plus, we'll talk about industry hot topics and conclude. Again, we do expect to go to 3 o'clock today, or 3 o'clock Eastern time, I should say. So with that said, a couple of things we want you to take away is, we think there's going to be an increase in enforcement efforts by the Department of Labor. So I'll go through what's out there. We'll talk about a lot of the penalties, which have increased dramatically since the Secure Act. And we're going to go through some of the IRS and DOL top priorities. So those are big takeaways. I'm also going to cover, I call them the top 10 failures in the qualified plan environment. Just so you're fully aware of at least the top 10 list. And we'll also, in conjunction with that, go through the top 10 concerns that both the IRS and the DOL have. As I mentioned, legislative initiatives are a big topic this year. So without further ado, we'll kind of get into it. So this is a snapshot published last November in terms of enforcement actions by the DOL. So there were $2.4 billion worth of monetary impacts, positive impacts due to the enforcement actions. They have 710 full-time folks assigned to enforcement. And as you can see, well over 1,000 civil investigations plus hundreds of criminal investigations. And I think the highlights here, almost 70% of the plans that were investigated were required to restore losses. And there were actually 72 people indicted for crimes against the various qualified plans that they were involved with. So it is serious business on the enforcement side. I would say for the typical plan, it's really not just necessarily the monetary aspect of restoring plans because they were damaged, but also there are fines and penalties associated with that typically get paid by the adopting employer. So here's a list of the top Department of Labor concerns. Late deposit deferral. I think everybody now knows that the general rule is to make contributions to the plan as soon as possible, and certainly with respect to salary deferrals. I mean, there are some laws out there on the books, been there for literally decades, that talk about getting money in the plan 15th following the end of the month in which the deferral is made. Well, that really, in this day and age, or enforcement is not an appropriate standard. For large employers, it's literally within a business day or two of that deferral that money really needs to get into plan. For smaller employees, there is kind of a safe harbor of a 7-day period. So don't rely on basic law, right? That kind of extends out nearly a month and a half potentially, beyond the deferral date. Excessive fees, those are certainly highlighted in the news. A bunch of law firms out there making allegations, about fees. Imprudent investments is another topic. Plan sponsor bankruptcies. We see some of those. We don't see a lot of that in our world, but we definitely see some of those. We've seen a couple of abandoned pension plans, where the plan sponsor is either, has gone through a bankruptcy or a dissolution of the business, and there are actions to be taken to kind of wrap up the affairs of the plan. Hard to value. Again, in our environment, we don't necessarily see a lot of that, but I do know there are a lot of typically smaller plans out there that hold all sorts of plan assets that are hard to value, whether it's rental real estate or maybe certain commodities for that matter. And another big concern is fiduciaries that don't know that they are a fiduciary and don't necessarily know how to fulfill their duties. So when we look at, the IRS concerns, they've got, some of them are related, some of them are directly on point, some of them are different. I'll highlight a few that are different. Mergers and acquisitions, certainly that happens all the time, and there can be a lot of confusion around that. A lot of that is really answered by the plan document itself. Now, a lot of plan documents are written in a way that either automatically include or exclude any acquisition that a business might make. So it's always important to take a look at the plan document when there's any merger or acquisition activity. A lot of times plan sponsors will make assumptions that are not correct or not in line with their plan document. Non-discrimination testing, I'm going to give you, I'll speak about it right now. There's a 10 we don't have in this presentation today of failures, and definition of compensation is certainly one of the top 10 but also not so much performing non-discrimination tests, it's really correction of called ADP or ACP, the deferral and the matching test. Many times testing has been done, but corrections haven't been made properly. So that's definitely a top 10 failure. Vesting schedules are another issue out there, applying the appropriate vesting to the various types of employer contributions. And we do see a lot of plans that have different vesting schedules for, let's say, employer. A plan might have 100% immediate match on matching 100% immediate vesting on matching contributions, but maybe they've got a graded vesting on profit sharing or discretionary contributions. So, we do see that as an issue that comes up. Some other things, I'm not going to necessarily read every item on this list, but a couple of other things that do make the top 10 failure list are eligibility in general, meaning some plans don't necessarily appropriately include participants who are eligible, or sometimes they go the other way. They inadvertently include people who are not eligible, and eligibility is always defined in the plan document or the adoption agreement to the plan. So, while it may seem relatively easy, I always, my golden rule is always look at the plan document for the answer, because it's undoubtedly going to be in there. Another top 10 failure that I don't necessarily see on either of these lists is processing required minimum distributions. Number one, doing them timely. And number two, making sure the amount distributed is in fact the correct amount. And another one that doesn't make the top 10 or list of concerns by the DO or the IRS is application of top-heavy minimum contributions. I won't go too deep into that today, but top-heavy plans mean that the plan has more than 60% of the total benefits attributed to certain key employees. And that's a different test, by the way, obviously, from the AD and ACP test. So that is a top 10 failure point. That may not be their biggest concerns right now, but we do see them out there. Again, I mentioned earlier, fines and penalties have increased dramatically since the CARES Act, and in a lot of the pending legislation, there's a lot of, and we'll get into it a little bit, but a lot of really good stuff coming through that is potentially going to make it law. And most of what's being proposed is going to cost the government, at least in the short term, revenue, right? Meaning they're not going to collect tax revenue because certain limits or plan design features are being improved. So again, I think the stop or increased fines and penalties for failures is going to be a real issue kind of, on a going forward basis. So this is one interesting thing, the slide that I have now. There is a pilot program the IRS is running that is, and by the way, once they run the pilot program, they're going to judge the effectiveness and potentially implement it more broadly. But basically, the IRS is sending a letter to the plan sponsor that it's selected for an upcoming audit, upcoming examination, right? So then at that point, the plan sponsor would have a 90-day window so they can kind of take a hard look at the plan, self-audit, so probably using some consulting advice, from somebody to kind of help them through that process, to look for errors and basically say, hey, you know what, we've got an error, whether it's eligibility or vesting or funding those contributions timely. And it would then give that plan sponsor the ability to make the correction to a much, much less expensive closing agreement. Because typically, right, in the past, IRS or DOL, in an audit, they found anything subject to the full wrath of the IRS fines and penalties or DOL fines and penalties for the failure. So, it's kind of an interesting program and definitely a positive departure from past practice. So I have a hunch that they're going to find that this program is in fact effective and would be, ultimately more widespread. Is this our first polling question here? How can sponsors identify if compliance issues exist?
Yes, it is, and I'm going to launch it on everyone's screen right now.
Okay, so I guess it's compiling results.
Yes, I'm going to leave it up for about 10 more seconds. For anyone who hasn't selected an answer, please do so.
Okay. Hopefully we'll see that in a minute. Do you need to close it, or can I poll here?
I'm going to close it right now, and then Rich, you're going to be able to continue with your slides.
All right. I don't see the results. Do you see them?
Rich, can you see the results posted now?
Oh, not yet. I don't see them. Can you, if you see them, why don't you read them out?
Okay, sure thing. So we have a 94% chose the answer A, which was conduct annual compliance reviews. And then we have a 2% for B, waited to be notified by the IRS or DOL. And then 4% answered C, rely on the auditor to address.
All right, good. Thank you. Let's see if we can move to another slide. And all right, so we're into some of the administration's retirement-related initiatives next. One of the topics out there is, we call it the Great Rollover Reset. And there was a DOL fiduciary package. It took effect back in the summer of 2000, and fully enforceable now. You can see my highlighting, July of 2022. This changed some of the old rules that were in place, and it reinstated an old 5-part test, which I'll put up on the screen in just a second. But really, this is all boiling down to, are you a fiduciary if you're making the recommendation for a rollover out of a qualified plan to an IRA of sorts. So I'll put the test up here in just a second. So I know there's a lot of words on this, but I'll just touch on a couple of them. You can kind of study this if you need all the detail later. Question 1, will the advisor write advice? Which includes, by the way, the advice to conduct a rollover. The answer is yes. Go to question 2, right? Will advice be on a regular basis? If yes, you go to question 3. Is the advice pursuant to an agreement between that account holder and the advisor? If yes, go to question 4. Will the advice serve as the primary basis for investment decisions? If yes, will the advice be individualized, right? So if the answer, flowing through is yes to all of these, in essence, the advisor will be deemed to be, a fiduciary with respect to that account and that rollover transaction. So, documentation of that is key day and age. If there's any challenge to that, if you happen to be an advisor and, you're challenged as to whether or not you're a fiduciary, it's good to have that documentation in place to make sure that you are or are not a fiduciary with respect to that rollover account. So, I'm not going to get too deep in this part of it now, but, this prohibited transaction exemption 2020-02, which applies to broker-dealers, RIAs, ERISA 321 investment advisors, other fiduciaries. So what this really is getting into is that fiduciary investment advisors have to have an impartial conduct with respect to the business that they're conducting, and they need to uphold best interest standards ultimately to that account holder, that participant, so to speak. Compensation has to be reasonable. They've got to provide certain disclosures to the investor. And, rollovers, they've got to document specific reasons to effectively advise to do that rollover. So, again, it's critically important if you're in the business, so to speak, of helping participants with rollovers to make sure that various components here are complied with. There was kind of a non-enforcement portion of this that went through June 30th of this year. But essentially, I think it's critically important to make sure that, you're documenting the fiduciary or non-fiduciary status of any of those rollover transactions. The other thing I think is that there's going to be some new rules on this on the horizon, in particular with the definite, in terms of defining fiduciary. So we're expecting that sometime this year. So, the bottom line of all this essentially means that if you're a financial professional and if you're getting investment advice, and paid for that advice, essentially you are a fiduciary with respect to that transaction and that account. Some of these rules are probably going to change a bit more. And I know a lot of folks have been putting a lot of study into this over the last couple of years in terms of what needs to be done to, appropriately document, I think, the procedures that you've got to be in compliance. And again, SEC is involved with finalized regulations on best interest concept. And again, broker-dealers have to act in the best interest of customers, can't obviously put their interests ahead of the client or the participant. And the same set of rules here provides insurers, provide reasonable care, avoid conflicts of interest, and have written policies and procedures. So, again, there's a big spotlight on the rollover segment of the retirement market. And a lot of that stems from the fact that the DOL, in many cases, that qualified plan, in many cases, might be a best solution for a participant. And some of the reasoning behind that is, qualified plans, in many cases, significant bargaining power with respect to fees and cost of services, so on and so forth. So certainly, large plan market. Retirement plan sponsors can drive down costs that are borne by the participants. So, really kind of goes back to that best interest concept of doing the right thing for the participant, not just from a fee perspective. I want to emphasize fees are not the beginning and end of every rollover decision. It is part of it, essentially, but you don't necessarily have to have a rollover solution that is a lower cost if there's value-added services being provided. That's one example of potentially being it, not necessarily just work, just comparing fees versus fees. So again, I think it's critically important to make sure that you're up to date with documentation required to comply with this, because the ramifications are pretty serious of being out of compliance with it. ESG has been a big topic. There were some rules that came out, I think it was about 2 years ago at this point. DOL proposed some rules with respect to ESG, and they had a final version that came out that took away, in many cases, reference to ESG, socially conscious investing, so to speak. And there's a lot of confusion. I know some of the larger retirement plan advocates in the industry are kind of saying there's not really enough of a means to benchmark various investment funds purely on an ESG basis. They get into looking at pecuniary rules versus non-pecuniary basis of investments and benchmarking, so on and so forth. And the last piece that the DOL came up with kind of omitted reference to ESG and kind of went back to a basis of analyzing fund performance, based upon typical financial metrics, if you will. So again, this has gone a little bit all over in the last 18 months or so. I think there's going to be a lot more that'll be written about it and more guidance that'll be provided over time. But I think, first and foremost, one thing I would say about ESG investing is, really to keep the plan participants' interest in mind. Anyway, I think that's kind of critically important, and we'll see more of this, as we move down the path here. Again, you can see at the bottom of this slide, the regulations didn't define what constitutes an ESG investment, didn't address ESG sales practices or concerns and issues rating services. So, certainly I think ESG analysis is important, in determining the viability of if you're looking at an individual security or stock, if you will, the viability of a company long term in terms of how you might expect it to perform over the long run. But it is not the only factor, really, I think is the point of what's been going back and forth over the last 18 months on this topic. So more to come on it is really what we think. We think it's here to stay. But again, doing the proper diligence on those ESG funds is I think, critically important to make sure that you're helping plan sponsors and plan participants have the best possible investment alternatives within a 401k type of a plan. Lizzie, it looks like our second polling question is here.
Correct. It is now launched, and I'll leave it up for about 45 seconds for everyone to submit their answers.
All right. And this is just a question on which of the following statements about ESG investments in a plan are true. On my screen, Lizzie, I can't see the choices. I don't know if I can read them off.
Sure. I can also read off the results. So the first choice is ESG is a separate asset class. Number 2 is can't be selected based off non-financial metrics only. Number 3 is a QDIA can be an ESG investment. And the last one is the DOL has issued ESG benchmarking for plan sponsors. And I'm going to give you guys about 10 more seconds to submit your answers.
And QDIA is qualified default investment arrangement, meaning if a participant fails to make an election with respect to how they're investing their money in 401k, there's typically a default investment specified in the plan document.
All right, and I'm now displaying the answers on every attendee screen, with 16% selecting ESG as a separate asset class, 32% selecting can't be selected based on non-financial metrics only, 21% is selecting a QDIA can be an ESG investment, and 32% selecting the DOL has issued ESG benchmarking for plan sponsors. And Rich, you now may continue.
And the correct answer is?
B, can't be selected based on non-financial metrics only.
Right. So we can see from the audience response, right? There's, a lot of variance in the way people are looking at this, right? So it kind of proves my point from earlier that there's still a lot of confusion, I think, in the marketplace with respect to ESG, what it means, how it works, and we certainly need more guidance on this whole issue. And I mentioned earlier, the ARA, American Retirement Association, formerly known as, has kind of come out with, white papers on the fact that there, a lot of the components of this, or the analysis that goes into ESG analysis, really isn't well defined at this point in time. So crystal clear to me that we need more guidance on it. So another topic out there is proxy voting. There are some newer rules on this that have come out, proposed rule last October, that proxies should be voted as part of the process of managing plan's investment unless a fiduciary determines that proxy voting is not in the plan's best interest. I'm not sure exactly what they mean by that. Typically, if you own a security and have the ability to, vote on a proxy, I'm not sure I have any really good examples of why it wouldn't be in the best interest of the plan to place a vote, so to speak. So, the other thing I do want to mention so basically what I'm saying here, if you have the ability to vote a proxy, you ought to do it, or your investment advisor should do it, or whoever's tasked with it should do it and not just ignore it, is the point. And the other thing is to do the proxy voting solely in the interest of plan participants and beneficiaries. So, this is another example of a fiduciary who kind of needs to put the fiduciary hat on in terms of acting in the best interest of participants and take the personal hat off, right? Your personal view or corporate view on how a proxy ought to be voted is not necessarily in alignment with what you ought to be doing on behalf of participants and beneficiaries in the plan. So that's an important distinction to make in proxy voting. So a couple of other things, could you push proxy voting to participants? Yeah, you could. I think some plans are doing that. I think that's a cumbersome process because there's a somewhat limited time frame to place a proxy vote and to poll the plan participants and then collect it and tally it up and then submit based upon that is, I think, a pretty cumbersome process. And again, this is really just kind of going through. You should have a policy and a procedure and stick to it if you can do that. So again, this is one of those issues that the DOL has kind of taken notice of, and what we're suggesting today is don't ignore it. Don't ignore the proxy vote. Do something with it is our advice. So we're going to get into, we've got a lot coming up here, legislation related to retirement plans and tax reform. Oh, Lizzie, it looks like our third question.
All right, you should all see the third polling question launched on your screen now. I'll leave it up for about 45 seconds for everyone to submit their answers.
Want to read the questions and
Sure. So the question is, do you feel your plan sponsor clients have forgotten about some of the Secure Act provisions from 2019? First answer is yes. Second answer is no. Third answer is most likely.
what do we have as results here?
About 5 more seconds for anyone who hasn't submitted their answer, and then I will close the poll.
Okay.
All right, the poll is now closed, and our results are as follows. 39% said yes, 14% said no, and 47% said most likely.
Yeah, that's kind of what I figured. I mean, there was a lot in the Secure Act, and I would say for the average person, it's kind of hard to keep track of everything that's out there unless there was a specific aspect of that law that that you've taken a particular interest in. So we're going to review some of this. I'll try to move pretty quickly through this because I want to get to some of the pending legislation that's out there. PEPs, pooled employer plans, which are really a subset of a MEP, which is a multiple employer plan. They were sanctioned by the Secure Act. There's right now, I think, 200 that have been established. Initially, the Department of Labor thought there'd be about 3,200 established. The uptake has been a little bit on the slower side, I would say. But I think the PEP marketplace is going to grow over time. One of the other things that was in the Secure Act is part-time employee coverage. I call this I'm going to say the acronym, the LPPT, long-term part-time employee. And this is really intended to deal with participants who just never really seem to work enough hours to become eligible for the plan. And what this said is, participant working at least 500 hours a year, an employee working at least 500 hours a year, but less than 1,000, and, because of that, you don't become eligible for the plan. What they've said is, if you have over 500 hours, right, for a 3 consecutive year period, you do become eligible for the plan with respect to salary deferrals. Not necessarily, by the way, for matching contributions or other contributions in the plan. And this was under the heading of broadening retirement plan coverage. Really is what the Secure Act was all about, enabling more people to save money for the long run. So I'm sure I'll mention it later if we get to it. There is pending legislation to make this 3 consecutive year period a 2-year period. It's not changed yet. That would have to be changed by law, but that is one of the pending legislative initiatives out there. Okay, so we're going to move on to a couple of other things here. The Secure Act also changed the deadline for establishing a plan. Previously, you had to have a plan in place by the end of the, for a employer by the end of that year in order to be in place for that year. What they did is they've extended it to the tax filing deadline. So, for example, we're in July of 2022. If I'm a calendar year taxpayer, and I'll just pick a simple one, I'm a regular C Corp. My tax filing deadline was April 15th. If I'm still on extension until October 15th, I can actually adopt a plan retroactive for 2021. We don't really see this happening in the 401k world. We do see it more in the defined benefit plan environment where, a company might say, hey, my profits, I think my cash flows are going to be great for the next couple of years. So, it makes sense strategically to put a plan in for last year and get a nice tax deduction for it. So again, that is a good feature that was put into the Secure Act. We have seen various employers take advantage of that, and it makes a lot of sense, and it takes a lot of pressure off the year-end plan design aspect. Another thing that was in the Secure Act is lifetime income disclosures. The due date of that is literally now. What they basically said is on your participant 401k statements, you've got to have an estimate of the lifetime income stream that participant's account would produce. Just a little bit of a hot topic for me, only because I wrote an article on this. I think it was the summer of, 2021. When the DOL came out with proposed rules on it, there are some flaws in their safe harbor provisions, and I'll describe them hopefully quickly here. What they basically said, and by the way, the final rule codified what was in the proposed rule. What they basically say is it doesn't matter what the age of the participant is. We need to take the participant's current accounts, and we need to assume age, I think 67, right? The new Social Security retirement age for a lot of people, not everybody, but a lot of people. And we need to convert it to lifetime income. If 66 years old, well, okay, that's reasonable, right? It's take my account balance, convert it to a monthly annuity benefit payment, show it on the statement, and it's a reasonable projection of lifetime income that participant can expect. Where it falls down, though, is if I'm 12 years old and if I have $1,000 in my 401k, I have to assume, or the record keeper has to assume that person is 67 and convert the $1,000 account into a monthly benefit. And it turns out to, I don't know, I'm making this up purely, $2 a month payable for life. The safe harbor rule on this doesn't permit a projection of the account to normal retirement age. It doesn't allow for calculation of assumed contributions. It doesn't allow for growth of the account for the next 40 plus years for a 25-year-old. So, the fear, I shouldn't say fear, we'll see what happens when those statements hit the street soon, is a lot of people, younger people in particular, will be discouraged by the number. So the case here is I know on our website for 401k plans, you can go out there and take a look. And I think the first thing that hit participant is I'm going to say a reasonable prediction of lifetime income. And the assumptions that we show on our website is, yeah, I may have $1,000 now, but I know that 25-year-old is contributing, $200 a month. I made that up. And at a reasonable rate of return, let's say 5% or whatever the number is, projected all the way out for 42 years for that person, that's a more realistic idea of what that income would really look like. So even though benefit statements, and by the way, the DOL mandated go on statements, and if you want to comply with Safe Harbor, which most firms will want to comply with the Safe Harbor, I think the lifetime income projection is going to be vastly understated for a lot of people. But the advice, go up on a website, take a look at it there, and get a better idea. Lizzie, we have our next polling question, which is following statements is true. Can you read the statements? And
Yep. Our fourth polling question is displayed on your screen. And the question is, which of the following statements is true? The first choice, which is A, is 500 hours is equal to 1 year service for vesting under the Secure Act. B, employers can exclude part-time employees from match. C, all employees who defer must receive a match. D, A and B only. And E, all of the above. I will leave the poll up for about 20 more seconds for anyone who hasn't selected an answer.
Okay. Hoping this one is relatively easy for most folks. I think we just covered this probably a couple of minutes. So I hope most people get this one right.
All right, the poll is now closed. And 22% answered A, 500 hours equal to 1 year service for vesting under the Secure Act. 20% is B, employers can exclude part-time employees from match. 2% said all employees who defer must receive a match. 39% said A and B only, and 17% said all of the above, and the correct answer is D, A and B only.
Okay, right. So, yeah, so when if you didn't get that one right, you'll see the PowerPoint later. I guess we'll ship PowerPoint out tomorrow, but okay. So I'm going to go through lifetime income, skip up to Secure Act 2.0, which a lot of folks have heard of. This is dipping our toe into the various pro-retirement provisions that have been introduced in both the House and the Senate. The House version has 51 provisions, and the Senate version has 59 provisions. So legislative initiatives are moving through both houses of Congress as we speak. I'm going to go through, I know we're going to be running a little short of time today, so I'm going to go through some of these pretty quickly. This has to do with PEPs, pooled employer plan, designate somebody other than essentially the trustee to collect contributions. Would be a good thing to put some relief on those people. Second bullet here is increasing the tax credit for small businesses from 50 to 100% tax credit for establishing a new plan. So basically, that's a cost item. I mentioned that earlier in the discussion. It's one of those things, if there's going to be tax credits increasing, there's a cost to the government of providing that tax credit. The third thing is potential for self-correcting unintentional plan violations. We talked about that earlier today. I'm going to pass this slide. Here's another slide. Okay. Simplify top-heavy rules. Again, a lot of people don't really totally understand top-heavy versus ADP and ACP testing. They're completely different tests. So helping simplify that stuff would go a long way here. Another initiative is treating 403B plans like 401k plans in order to enable them to invest in CITs or collective investment trusts, typically similar to mutual funds, typically much lower cost of running those funds. Here's what I mentioned earlier, the second bullet, the LT, long-term worker, changing that rule from a 3-year rule to a 2-year rule. Again, I will be embedded in legislation that comes through from both houses. The bottom bullet here is interesting, and this has been talked about for a long, long time, with the typical employee changing jobs, right, up to, 10 times during a working career. There really is a need for, been found on the defined contribution side of our business, the retirement business. People move, change jobs, forget to do something with their old account, and the rules out there enable plan sponsors to cash out small accounts that are $5,000 or less than $5,000, I should say. And a lot of those account balances end up getting escheated to the state in which that person resided. And so really is a need for a consolidated online lost and found contribution plans participants, right? On the next slide, I highlighted treating student loan payments as elective deferrals for purposes of getting matching contributions in a 401k plan. A couple of years ago, there were a couple of big employers like Abbott Labs was the first one that asked IRS via PLR, private letter ruling, could they consider student loan payments that certain workers were making, use those as a basis to make a match to the plan on behalf of that participant. And Abbott Labs got a favorable ruling on that. And ever since that, I think there was another employer that got the same favorable ruling. But ever since then, more and more employers have been saying, hey, can't we do the same thing? And by the way, the premise here is, if I'm repaying student loans and I've got a pretty heavy burden to do that, I maybe can't afford to contribute to my 401k and get the match. So, this is embedded in some of this pending legislation that's out there to enable employers on a voluntary basis to treat student loans as deferrals and at least make a matching contribution for those folks in their qualified retirement plan. So again, I think that's one of the things that'll probably make its way through, and that would be a good thing for those participants. And again, employer by employer, they could decide whether or not they wanted to adopt that feature. Here's another one, raising the required minimum distribution age from 72 to 75. I think we will recall that went up to 72 as part of the Secure Act, and they're looking to maybe push that to age 75 over some period of time. So again, this is one of those features. And again, most of the 51 or 59 features that Congress has in the various pieces of legislation are all good things for either participants or sponsors. But there's another one that will cost the government money, because if people are not required to take money out and tax on it, 75 now, that means delayed tax receipts for the government. And again, this kind of dovetails into the fact that IRS fines and penalties, right, have increased by 10. Certain penalties that were $25 a day penalties with a $25,000 cap are now $250 a day penalties with a $250,000 cap. So again, it's more reason to think the enforcement actions will be much more going forward, or certainly much more painful for the employer going forward for various failures. And again, think about that pilot program the IRS is running and saying, hey, we're going to send you a letter telling you we're going to audit you. Find your own defects within 90 days. I think is really the best way the government is saying, find it on and fix it, and you can fix it relatively inexpensively. But if you don't fix it within those 90 days, I'm going to tell you these more severe penalties are going to flow through, and has gone into, every time there's a piece of legislation, there's always a determination of the cost of the legislation, whether it's compliance cost, right, by the end user client, or what's the revenue hit to the government. And these increased fines and penalties are going to be a way to justify an offset to the cost that the government is providing through the various additional breaks that they're putting in place here. Continue to move relatively quickly here. Right. So the top bullet talks about target date funds and benchmarking, and benchmarking and participant disclosure, benchmark investment funds and disclosure to participants is a key element of running a 401k plan. And there's been, in my view, right, a bit of a disconnect on a lot of target date funds, right, because they're multi-asset. They've got investments typically in whether it's stocks and bonds and cash in a variety of diversified segments in all of those categories. A lot of times a target date fund will be benchmarked against, an S&P 500 fund or a Wilshire 5000, like an old equity index of some sort. And that may not really be the appropriate benchmark. So this is really some legislation to allow for a blended broad market index to do the comparison. I think certainly at a participant level, it'll make it more clear. It'll be more apples to apples is the bottom line here. So that's just a good thing. I don't think that is really a cost in either way. Certainly not a tax revenue loss to the government. It's just kind of cleaning up something that needs to get cleaned up. They're looking at also raising the forced cash out threshold from 5,000 to 7,000. Again, I don't think that's a real revenue item for the government, but it's just probably taking into account some inflationary aspects over the last couple of years. Okay, so we're going to press through a few more here. Some of the other bills to watch. There's something called the RISE Act, Retirement Improvement and Savings Enhancement Act. There is the Rise and Shine. There's a Women's Retirement Protection Act, and there's the Inform Act you can see at the bottom. So a whole bunch of stuff that is kicking around Congress right now. Is this our fifth or sixth maybe question?
This is our fifth. This is our fifth poll, and I'm going to launch it now. And the question is, true or false? The Secure Act 2.0 took effect January 1st, 2022. And it is A, true, B, false. And I'll leave it up for about 45 seconds for people to submit their answers.
That one's going to be a little bit trickier because I did mention the effective date earlier in today's discussion. I know in prior webinars, focused primarily on the Secure Act. We talked a lot about the effective date. But I am interested in what the response is from the group.
All right, I will be closing the poll out. And to share the answers, 26% said true, 74% said false, and the correct answer is B, false.
Right. So just a quick comment on that, and I don't know if it's a trick question. It's almost a question. The Secure Act passed in late December of 2019. Had various effective dates. The earliest effective date was January 1 of 2020. So the people who selected A don't feel bad. There were some provisions that were effective in 2021 as well as 2022 and beyond. So I would give you partial credit if you selected A, but B is the real correct answer. A couple of other things here. I don't know how much I'm going to go into. Well, I will go into cybersecurity. Cybersecurity is, I think, really important. There's not necessarily a lot of requirements or rules per se, but the DOL did come up with kind of an RFI or an RFP that you could send to the vendors who might be servicing your retirement plan. They kind of came up with a recall, a list of 10 questions or so to ask a service provider. And then they came up with a much more detailed version of that. I know we did a prior webinar on this topic and had some recommendations on this, but I really need to be attention paid to this. We're seeing more in the industry more cybercrime out there. Not necessarily seeing a lot less of the regular type of crime, right? But a lot of the hackers seem to think it's easier to essentially steal money electronically. And that can be done any number of ways, right? Intercepting passwords or somehow infiltrating systems, things of that nature. So if you are a plan sponsor and if you ask your service provider, whether or not they're in compliance with the Department of Labor version of cybersecurity best practices, email us or whatever. We want to give you the format to take back to your current service provider if they're in compliance. It's one of these things that I think is pretty important to do as a fiduciary of your plan. And essentially, make sure you're getting, you've got service providers in place who can comply with what's already published out there. Lizzie, I know we're getting short on time here. So let me just go through a few more slides here, and we'll see if we have a couple of questions. This slide I'm not really going to talk about now. It talks about some positive impacts to defined benefit plans. Here's a good slide, which we're well into 2022, but you can see various limitations have increased for this year. Elective deferral limit, salary deferral limit went up to $20,500. Catch-up contribution limit stayed. And just a quick comment on that. Comments on that. All of these limits get indexed up with inflation, but they don't index based upon pure inflation rates, right? They move in either $100 or $1,000 increments, and if there wasn't, and the limit is good, there wasn't enough of an inflation increase between those 2 years to bump it to the $7,000 level. But what happens is inflation is calculated on a cumulative basis, right? So if it wasn't enough to get it to 7,000, probably by next year that'll be up to 7,000 because they'll take 2 years in a row or 3 years in a row or whatever the cumulative inflation rate, CPI rate, and bump it up to kind of get an even number on the various limits. And again, inflation has been running, 8 or 9% more recently. I would expect a lot, maybe not all, but probably most of these limits to go up again next year. The next slide, just for convenience, we put some the IRA limits out here also. Lizzie, again, very on time. Do we have any questions that we can maybe address?
Sure. So one question that was submitted was, do you think that any of the pending legislation will pass into law?
Yes. The answer to that is I was asked that question last year, a couple of times last year, and I'll admit I actually thought this would have made it to a legislative effort last year. This year, even more certain that this will come through. Pretty much all of the things that we talked about, plus some of the things that we didn't talk about. As I mentioned, there's 51 and 59 different, mostly positive things for plan participants and plan sponsors that are pending out there. This is, I think, going to be a true bipartisan effort. Retirement plan legislation typically doesn't go through, right, as standalone legislation. Typically, it gets attached to some other legislative initiative. Good example, most recent good example is the Secure Act. That was, gosh, I can't remember how many pages of legislation, like well over 1,000. And that was attached to a year-end, either a budget bill or a spending bill, right? So that was the most significant retirement plan legislation that we've seen in probably since ERISA, quite honestly. And even that was attached to a separate bill. So I think it will pass into law, and I actually think it'll get done before at some time. Any other questions, Lizzie? One more we'll take.
And then we just had the piggyback question onto that one, which was, when do you think that will happen?
Oh, okay. I was almost, yeah. So I definitely think it'll get done closer to year end, honestly, because again, they got to find another bill that is probably going to make it through both houses of Congress. So my best guess would be year end is when we're going to see this, with some of this stuff effective as early as next year. So with that said, I want to thank everybody for participating today. If you have follow-up questions, please send them in. As Lizzie mentioned earlier, I think there's a pop-up poll that comes up here. And if you're looking to get credits, let's make sure we give them to you. So again, thank you everybody for your time today.
All right, thank you, Rich, and thank you everyone for attending. We will have a pop-up survey that will come up when you close the app, and everyone have a great rest of your day.